A member of the Federal Reserve Board and the chairman of the Federal Deposit Insurance Corporation testified Wednesday. They talked about the effect of non-payment of credit card debt on personal and business finances. Republican Senator Richard Shelby chairs this 2-hour and 10-minute Senate Banking Subcommittee hearing.
Subcommittee will come to order. I will try to be brief on my opening statement. We appreciate all of you being here today. Credit delinquencies hit a 15-year high. Non-business bankruptcies projected to reach over 1 million this year, setting a second straight record. Credit quality of the average American credit card holder at a 6-year low. Net charge-offs for banks increased 58% in the first quarter. Default notices for mortgages jumped 38.3% in the first 4 months of this year. These are the headlines we keep seeing day after day in America. At the same time, we're being told that this is the best economy in a generation. Indeed, unemployment is at a 6-year low of 5.3%, and we're consistently receiving strong data on industrial production. However, despite the aggregate data, the benefits of this economic expansion do not seem to be getting through to the individual household. According to the Congressional Research Service, this expansion has witnessed the weakest growth of GDP when compared with 3 similar expansions. In addition, domestic sources of savings have been weak, and the investment spending has depended largely on foreign capital. The growth rate of productivity is the lowest compared to similar expansions, which might account for the weak growth in real family income. The growth in the labor force has been the lowest of the 4 expansions, which would help explain, I believe, the low level of unemployment. Last week, before the Banking Committee, Chairman Greenspan noted, and he said, voluntary job leaving to seek other employment appears to be quite subdued, despite evidence of a tight labor market. The point being that the workers are abnormally concerned with job security in this current economic environment. The reason I mention this morning is because some economists suggest the economy is doing very well and that consumers are simply using credit because they feel comfortable being leveraged in this economy because their net financial household wealth has increased thanks to the rise in the stock market. While that explanation seems plausible, I'm reluctant to buy it whole cloth. First, I'm not convinced that the majority of consumers using credit are doing so because of the rise in the Dow. A lot of consumers do not have equity in financial markets and therefore would reap little direct benefit from any gains therein. Secondly, one could argue those gains are only on paper and could be lost as quickly as they've been acquired. More importantly, much of this increase in household assets are locked up in pensions. That is, the gains cannot be made readily available to pay the mortgage or pay off credit cards. Bankruptcies and delinquencies have started to cut into financial institutions' profits. Friday, one company reported a 26% drop in credit services earnings, where provisions for loan losses has soared 89% in the second quarter. Unfortunately, it seems such losses are becoming a trend for the industry instead of the exception. Several financial newsletters are warning of the risk credit card portfolios that they impose on financial institutions. And one newsletter in particular has stated that credit cards are the #1 risk in banking today. In fact, now that the quality of credit card portfolios are deteriorating, some banks are trying to rid themselves of the problem by selling their credit card portfolios. The deterioration in credit quality is not, however, limited to credit cards. The Mortgage Bankers Association of America reported that the overall delinquency rate on mortgage loans, quote, has worsened over the past year, with the delinquency rate increasing 52 basis points from its level of a year ago and 56 basis points from its cyclical bottom reached in the third quarter of '94. The mortgage bankers go on to say that the seasoning of low down payment loans originated in '94 and early '95 and upward adjustments on many adjustable rate mortgages have contributed to the rise in the delinquency rate. The Mortgage Bankers Association of America was scheduled to testify here today but was unable to attend due to scheduling conflicts. But in short, delinquencies foreshadow losses. If consumers are already this far in debt and credit quality is already so low, what implications does this have for financial institutions if the economy slows or interest rates rise? What effect will a tightening by lending institutions have on consumer spending and the present state of the economy? To the extent banks find their loan portfolio overexposed, the greater the likelihood a downturn will cause unforeseen consequences. As one analyst put it, if consumer debt problems become serious, they won't be limited to the consumer. Virtually every business in the country will feel the impact. Senator Bryan?
Chairman, thank you very much, and let me preface my comments this morning by thank you for convening this important hearing. The subcommittee is holding this hearing against the backdrop of a strong economy. Economic growth has been robust. The private sector has been growing at a rate of 3.1% over the past 3.5 years. This growth has sparked the creation of more than 10 million new jobs and pushed the unemployment rate down to 5.3%. And for the first time in a long time, wage gains are outpacing inflation, which means that real wages are finally increasing. Given the strength of the overall economy, it is no surprise that the banking industry is decidedly healthy. Bank failures are down and bank profits are up. Faced with confident consumers, many banks have aggressively moved to expand their businesses, especially in the area of credit cards. And yet recent data indicates that there may be some cause for concern in the area of consumer debt. In recent months, banks have been reporting sharp increases in credit card losses and have been increasing their loan loss provisions to protect themselves from anticipated further losses. Over the last month, data has indicated that credit card delinquencies are at a 15-year high, and the percentage of people falling behind in their mortgage payments are at the highest level since 1992. To the extent that this data indicates a potential problem, the question arises is what causes these losses and what can it be attributed to? Credit card loans have become the fastest form of loan growth for banks in the past 2 years. Since 1994, 7,000 card issuers mailed more than 5 billion card solicitations to potential borrowers. This means that every person in America between the age of 18 and 64 received more than 32 card offers, and consumers are accepting these offers. Since 1992, outstanding credit card debt has increased by 47%. In fact, in 1995, there was $360 billion outstanding in credit card debt. Much of this growth is generated by banks tapping into new pools of potential borrowers. As markets for the most creditworthy borrowers become saturated with access to credit, only those markets with less creditworthy borrowers remain. And unfortunately, many of these borrowers in these markets are people who can ill afford to shoulder the high interest rates and high fees imposed as the cost of their loans. The fact that credit cards are being issued at a dizzying rate was recognized last week by Alan Greenspan, the chairman of the Federal Reserve Board. When asked at our last hearing, Mr. Chairman, by you, about the credit card delinquencies being at 15-year high, Mr. Greenspan said, and I quote, "We do recognize that the major cause of the rise is the extraordinary expansion that has occurred in recent years in the issuance of credit cards of all varying types," end of quote. Mr. Chairman, I look forward to today's witnesses for an elaboration of how banks are participating in what Chairman Greenspan has characterized as an extraordinary expansion of credit cards, whether banks are implementing changes in their credit card underwriting standards, and what the regulators are doing to monitor the increases in credit card debt from the perspective of both the banks and the consumers. And again, I thank you for convening this hearing and yield.
Senator Mack?
Thank you, Mr. Chairman. When I heard you state at the beginning of your comments that you would make a short statement, it was my intention to say I was going to make an even shorter one and not say anything, but I do have a prepared statement which I'd like to have
be
included
made part
in
of the record in its entirety.
But I can't, and with all due respect to my dear friend from Nevada, I can't let some of the economic numbers that I heard. I really did not come here with the intention of getting engaged in some kind of economic debate. But the numbers that I see that reflect what's going on in the economy, if you take the last 4 quarters of GDP growth, if my memory holds right, it's about 1.7%. The last 4 reported quarters, 1.7%. Now, I know the President loves to talk about the strongest economy in 3 decades, but I mean, you know, that's a perception that I think that's going to be under attack during this, between now and November. I mean, 1.7% GDP growth in the last 4 reported quarters. Now, there has been an increase in growth that was indicated in the first quarter. I think it was 2.8%, which was revised downward to 2.3% or 2.5%, I've forgotten which. It's expected high levels of growth in this next quarter that's going to be reported. But again, let's put this in context. In the 3 years that Clinton has been in office, the growth rate has been 2.3%, not 3.1%. This is the weakest economy, I would make the claim, the weakest economy in 3 decades, just the opposite. It's going to be an interesting debate that's going to take place between now and November. One of the other things that's going on is that people have analyzed that this gap, in essence, that's taken place. If we were to grow as we have in the previous 10 years to the Clinton administration, if we were to have grown at that same rate during these past 3 years, the typical American family would have had $260 more. And Mr. Chairman, I want you to hear this because it does relate to the ability of people to pay their debts. If the growth rate of the economy had been the same in these last 3 years as it was the 10 years preceding President Clinton, there would have been $260 more in monthly income for the typical family in America. So there is a real growth gap. And I believe that the Clinton economic policies have, in fact, are robbing America of its economic potential. And so, as I say, I really didn't come here with the intention of getting engaged in a debate about the state of the economy. Really was more interested in what was going to be said about the quality of assets of the banks in the country and credit cards in specific. But another point that comes to my mind as I was jotting these notes down again, there's a 17% increase in the number of individuals holding a second job in just the last 3 years. 17% increase. And for women, it's a 20% increase. So one could make the argument that people are in fact taking second jobs to be able to handle their debt. That's off the top of the head, so I don't know whether there really is data to support that. But this is not a strong economy. And for us to be willing to accept a position that 2.3% is strong growth, and we ought to accept that, is just fundamentally flawed. So with that opening remark, I will now yield back my time. Thank you, Mr. Chairman.
Chairman, I don't want to get into a debate with my friend, my colleague. I think the witnesses will offer a different perspective. I would simply say that Chairman Greenspan seems to be primarily concerned about the economy being too strong and reigniting inflation. So somewhere we ought to be able to have some kind of an agreement here that the economy is doing extremely well. In fact, I think growth projections are going to be this quarter something in the neighborhood of 4%. So we can discuss that with my friend and hear the witnesses. It'll first, I'm sure.
I don't know whether this will be the last word, but
probably not.
I think if you listen to Chairman Greenspan closely, what he is saying is that the economy is growing at its potential. To go beyond it is to risk inflation. The real issue is what is causing America's growth potential to be so low. Why is it 2.5% as opposed to 3.5% or above? That's the real issue. America's growth rate has declined because, frankly, of fiscal policy, not monetary policy. Fiscal policy that has layered on American business, American families, and the American worker higher levels of taxation, more Washington interference, and more regulation.
Senator Amato.
While I have my two distinguished members of this committee here, Senator Bryan and Senator Mack, both good friends, I would urge us to get together to get our deregulation bill on that floor. So please, both of you.
We agree.
All right?
Senator Bryan, I agree with that, and we'll do our best to work at that.
And working together, Mr. Chairman, to make you pleased with our performance.
That would be, I mean, no, that would, I think that's a good, sound bill. I don't think there's any question on either side. There's some matters that we want to try to deal with, and I just would renew our request because, and I know that the chairman of this subcommittee, Senator Shelby, and let me commend you, and Senator Mack, have worked, and as have other members of the committee, to produce a bill that I think will help the economy, that will get rid of costly, unnecessary burdens that will actually free up tens and tens of millions of dollars that can be used as capital, expand it many times over. I don't know whether for each dollar of capital you get $18 that you can put out there in the market or some sort of leverage. Like, is that what it is, Mr. Comptroller? What is the leverage that a bank gets from a dollar of capital? Is it 36 or 18? I don't know. I guess you don't know, but huh?
It's an 8% capital requirement. So
No. Okay, so 8%, so you multiply it 12, 13? Yeah, so we're talking about if we can keep in that system that capital as opposed to being used for expenses, we're able to improve this economy and get this economy growing. Let me say to the chairman, he has done, not only in terms of calling this hearing, but in terms of his work and leadership as it relates to the regulatory relief bill, an outstanding job. I'm going to ask that my full statement be placed in the record as
without objection,
read in its entirety. I note with some interest leading story in the Wall Street Journal today, and it says banks grow less elastic about plastic. That's today's Wall Street Journal, and it says delinquencies spur first card crackdown in years, and it goes on to talk about the surprising number of delinquencies, and they are at least vigilant. And I want to say that I'm pleased that the institutions themselves are obviously aware of this. I mean, because this becomes public. The American Banker today, page 1, big banks reining in credit cards for consumers, because the fact of the matter is, as testified to by Chairman Greenspan, and he did not seem to be overly concerned in his report to us, but he did testify that there were increasing defaults, and I think that you are acting in a very prudent manner. So we don't want to have a situation where we wake up later rather than sooner. We do have an obligation to be ahead of the curve, where we're talking about taxpayers' money and the potential for unnecessary exposure. And so I'm pleased to call you, because I think that the words of and the actions of our regulators are such that they are tuned in to this situation, and they will be reporting to you. I've had the opportunity to look at some of their testimony as to how vigilant they are and will continue to be, so that we can avoid the problems that we have had where we did not have adequate supervision and we allowed the problem to grow well beyond, wind up costing the taxpayers tens and tens of billions of dollars. We don't want to see that take place. And I am confident under your leadership, with your oversight as well as that of the regulators, that will not come to pass. And I must say, I think the awareness of the banking institution itself, I think it has demonstrated a much more responsible attitude in dealing with these kinds of situations. So I commend you, because I think the more light you can put on this, the better off we all are.
Thank you.
Senator Grams?
Mr. Chairman, if I just for a comment very briefly.
For a minute.
For a minute. Listen, I just want to commend the chairman. I believe that it was under his leadership when he kind of sounded the alarm about the rising cost of credit card interest some years back. I think you've played a major role in creating the kind of competitive environment to help to keep those rates more in check.
Thank you very much.
Senator Grams.
Thank you very much, Mr. Chairman, and I also will keep my remarks brief, but I want to thank you for holding this hearing. It's very important because it focuses on the disturbing development in our economy that has been occurring since the middle of 1994, and that is consumers are having trouble managing and paying off their debts. The number of credit card delinquencies have increased to levels that one would usually see during a recession. According to the FDIC, total consumer debt as a percentage of disposable personal income is now at an all-time high of 83%. Of the $212 billion in outstanding credit card loans, 4.18% of this amount is being charged off. Even more disturbing is the dramatic rise in the personal bankruptcy filings, which are also at record levels. In the first quarter of 1996 alone, there were over 250,000 personal bankruptcy filings. It appears at this time that the current level of delinquencies pose little risk to the Federal Deposit Insurance System, as banks and thrifts have set adequate loan loss reserves. However, we'll be interested this morning in hearing from our distinguished witnesses on their views on the significance of this troubling development in our economy. And so with that, I'd like to close and listen to our witnesses. Thank you, Mr.
We have a distinguished panel today. I want to introduce them to the committee. Honorable Janet Yellen, member of the Board of Governors, the Federal Reserve System. Ms. Ricky Helfer, Chairman of the Federal Deposit Insurance Corporation, and Mr. Eugene Ludwig, Comptroller of the Currency. We welcome you to the committee. Your written remarks will be made part of the record in their entirety, and I would ask each one of you to sum up your testimony the best you can, as quickly as you can. Governor Yellen, we'll start with you.
Thank you, Senator Shelby. I'm pleased to appear before this subcommittee today to discuss trends in consumer lending and the Federal Reserve Board's view of how recent developments in this sector are affecting U.S. commercial banks. I will be brief, Mr. Chairman, and ask that my full written statement be inserted in the record.
It will be.
As with most things economic, the rapid growth in consumer debt in this expansion reflects both demand and supply. On the demand side, economic conditions in the United States have been favorable to growth in spending and borrowing by the household sector. Non-farm payroll employment has increased substantially, and the U.S. unemployment rate has fallen to its lowest level in 6 years. Personal income has risen sharply, and rising financial asset values have produced significant gains in wealth for some households, while lower interest rates and the associated mortgage refinancings, especially in 1993, allowed many consumers to significantly reduce their monthly mortgage obligations. On the supply side, lenders, banks and others, continue to be attracted by the long-term profit potential of consumer credit. The growing popularity of credit cards has been supported by their aggressive marketing at some banks, with the competition for market share contributing to declining rates and fees, and no doubt to greater risk-taking by some lenders. With both supply and demand factors supportive, non-mortgage consumer debt has grown at double-digit rates over the past 2 to 3 years. Revolving credit, which is primarily credit card debt, has been by far the fastest-growing component of consumer debt, extending a trend of at least 2 decades. In part, the growth of revolving credit represents a substitution of a more convenient form of credit for other more cumbersome types of borrowing. Surveys show that around 80% of U.S. households now have at least one credit card. As is normally the case, the early stages of this recovery after the last recession was accompanied by declining consumer loan delinquency rates. And as is typical when expansions mature, over the last year and a half, delinquency rates and personal bankruptcies both are up. With time, errors materialize in previous credit judgments, and some borrowers find that they've borrowed too much, or the changes in their circumstances have made a once manageable level of debt difficult to handle. In this expansion, some increase in delinquencies also could be expected from declining standards associated with increased competition in the credit card market. In response to the indications that credit standards may be declining, about a year ago, the Federal Reserve issued an advisory letter to its examiners and supervised banking organizations, cautioning them about the risk of weakening standards. It's encouraging that our supervisory activities, surveys of examiners and of bank lenders, and discussions with individual banks all support the view that banks have already begun to recognize weaknesses in the consumer lending market and are actively adjusting their underwriting and monitoring procedures for these loans. Mr. Chairman, I'd like to conclude with what I believe is a critical point for evaluating the rising credit delinquencies that have recently made banks more cautious in their consumer credit portfolios. As noted earlier, banks have been attracted to consumer loans in general and credit card loans in particular, by the high profitability of this market. But bankers understand that higher risks and higher returns go hand in hand and have historically allocated higher capital and reserves to such credit portfolios. Put another way, lenders active in the credit card business traditionally have been conscious of their likely higher loss rate and have priced such loans to provide for sufficient cushion to absorb higher losses and still produce a profit consistent with the risk exposure. Banks also are aware of the necessity to take steps to ensure that the variance in returns on these loans do not create significant solvency concerns for their organizations. Still, some individual banks during this expansion have engaged in aggressive underwriting practices for which they are now paying the price in higher than expected charge-offs and increased reserving. The point is, however, that in each case they have the resources to absorb the losses and that they and others have modified their procedures as a result. More generally, the industry's condition is quite strong when measured in terms of its profitability, capital ratios, loss reserves, and overall asset quality. Virtually all of these and other conventional measures of the industry's financial health are also strong. Unless future conditions deteriorate dramatically, we believe that the industry is well positioned to absorb any problems resulting from the competitive consumer underwriting practices of the recent past.
Thank you, Governor. Chairman Helfer.
Thank you, Mr. Chairman. Senator Bryan, Chairman D'Amato, and members of the subcommittee, thank you for the opportunity to present the Federal Deposit Insurance Corporation's views on recent developments in consumer lending. My written testimony provides a detailed discussion of trends in consumer credit for FDIC-insured institutions, that is, commercial banks and savings associations, which hold more than 1/3 of all consumer loans, or about $1.7 trillion of the $4.8 trillion in consumer credit outstanding. In interest of time, I will submit my written statement for the record. I want to hit on a few important points this morning. Today we are witnessing an unprecedented period of prosperity for commercial banks and savings institutions. In the last 4 years, commercial bank profits have reached the highest levels in the 63-year history of the FDIC. Capital to asset ratios are higher than at any time in more than 50 years, and overall asset quality is the best it has been in 14 years that we have been tracking the information. Last year, insured savings institutions posted their highest return on assets since 1962, set a new record for full-year earnings, and now have average capital levels exceeding those of commercial banks. Historically, consumer lending has been profitable for insured depository institutions. It remains so today for the vast majority of institutions. There are, however, 3 related dark spots on the banking industry's otherwise very bright picture. 1, levels of consumer debt. 2, increases in personal bankruptcies. And 3, rising losses in credit card lending. While the FDIC does not believe that there is cause for significant concern, we are closely monitoring industry trends as well as the performance of credit card and other consumer loan portfolios at individual institutions. Rapid growth in consumer credit has contributed to the present record ratio of consumer debt to income. As this chart shows, the ratio of consumer debt to income is at an all-time high of 83%. Debt service payments are at their second highest level since 1975, 16.7% of disposable personal income. This trend merits continued close monitoring, in part because of the heavy load of consumer debt, which may contribute to the growing number of personal bankruptcies, which, along with credit card losses, have been increasing during the general economic expansion. Personal bankruptcies and loss rates on credit card loans show a striking correlation over time, as this chart illustrates. Bankruptcy filings and credit card losses have risen significantly in the last 4 quarters. For the first time, annual personal bankruptcy filings are expected to exceed 1 million during the year. These recent adverse trends merit our attention because they affect credit card lenders. High yields on credit card loans have spurred institutions to expand lines of credit for credit cards. This chart shows the large growth in credit card loans at commercial banks in the last few years. The growth of unused credit commitments not drawn upon by consumers has been particularly large. These commitments grew from $497 billion as of March 31, 92 to $1.1 trillion at the end of the first quarter of this year. Credit card lending is currently highly profitable. As this chart makes clear, banks that specialize in credit card lending had more than twice the average return on assets of all insured institutions in the first quarter of 1996, 2.34% compared to 1.05%. Moreover, in earlier quarters over the past few years, credit card specialty banks reported about 4 times the returns on assets that all insured institutions reported. High average yields and margins traditionally have more than offset a relatively high loan loss rate for credit card loans. In the first quarter of this year, for example, banks that specialize in credit card loans charged off 3.9% of their total loans, compared to a net charge-off rate of 0.5% for all insured institutions during the same period. Because of the profitability of the business, credit card lending is not now a problem. However, because of structural changes in credit card lending and concentrations in individual institutions, we need to monitor the business to remain alert to potential problems. Those structural changes, which may make past performance less relevant as a guide to future prospects, include stronger competition in an increasingly saturated market, demographic shifts in underwriting, a rise in securitization, as well as in growth in unused lines of credit, the rise of personal bankruptcies, and the rise in consumer debt burden, as mentioned earlier. These structural changes are discussed in detail in my written testimony. In addition, credit card lending is highly concentrated in relatively few institutions. Almost 2/3 of all credit card loans outstanding at FDIC-insured institutions are held by 77 banks that specialize in credit card lending. These credit card specialty banks are insured institutions whose total loans exceed 50% of total managed assets and whose credit card loans exceed 50% of total loans. The profitability of specialized credit card banks, signs of recent tightening of lending standards, and other factors discussed in my written testimony suggest that credit card banks as a whole do not pose a threat to the Deposit Insurance Fund. What is true of the credit card industry on average, however, may not be true of individual institutions. The FDIC's losses at any given time are determined not by the average performance of the industry, but by the performance of individual banks and thrifts. While most institutions with higher concentrations of credit card receivables are highly capitalized and profitable today, individual institutions could encounter problems in the future depending upon economic and other trends. The FDIC is closely following their condition and performance through special quarterly reporting, examinations, and other supervisory initiatives. In conclusion, the banking industry is in strong financial condition. Consumer lending does not pose a significant risk to the deposit insurance funds at this time, but there are a few dark spots in a generally very bright picture that merit continued monitoring. Thank you, Chairman Shelby, for holding these hearings, Senator Bryan and other members of the subcommittee, and I look forward to answering your questions.
Our next panelist is Eugene Ludwig, Comptroller of the Currency. Mr. Ludwig.
Thank you, Chairman Shelby, Chairman D'Amato, Senator Bryan, and members of the subcommittee for this opportunity to testify on this important subject. I have a detailed statement that addresses recent changes in consumer lending activity by commercial banks and how the OCC has responded to these changes and the issues they raise. I'd like to submit that statement.
That will be made part of the record in its entirety.
Thank you, sir. Over the past decade, America's commercial banks have gradually shifted more of their resources into consumer lending, and today they hold more consumer loans than commercial loans. At the end of the first quarter of 1996, consumer loans accounted for 27% of bank assets, compared to 25% for commercial loans. This shift in the business of banking is a result of a variety of factors, including, importantly, a shift of traditional bank corporate customers to the capital markets. The largest and fastest growing area of consumer lending is in loans secured by 1 to 4 family real estate. This segment of bank business has more than doubled in the past decade. In 1984, residential real estate loans represented 7% of bank assets, compared to about 15% today. Installment loans have also increased, although at a slower pace, and now account for 7% of assets, as opposed to 10% a decade ago. Although credit card loans account for less than 5% of total commercial bank assets, this category has grown rapidly over the past 3 years. While the growth has been dramatic in credit card loans, only a small number of commercial banks, about 134, have a portfolio of credit card loans that exceeds 10% of their assets. This expansion into consumer lending has come at a time when the national economy is strong and bank profitability and loan loss reserves are at historic levels. Today, capital levels are at their highest levels in years, and the number of problem banks has ebbed. The strong economy, coupled with revenues from new lines of business, have led to 4 consecutive years of record bank profits, and while not a quarterly record, figures for the first quarter of '96 are quite strong. And preliminary indications are that the second quarter, the earnings picture, will be equally healthy. While the national banking system is today quite strong, the OCC continually assesses trends in banking that could present safety and soundness concerns and takes appropriate action when necessary. In this regard, we have monitored consumer lending activities at national banks and taken supervisory action to stem potential problems. Consumer loan credit quality has shown some slippage at commercial banks over the last couple of years. In particular, since 1994, loss rates and the percentage of delinquent credit card and installment loans have increased. Why are we seeing some deterioration at this time? My written statement attempts to answer this question in more detail, but in summary, I believe the causes are both cyclical and secular in nature. Some deterioration in credit at this stage of the business cycle is not unexpected, particularly given the low level from which this indicator is rising. In addition, employment growth has slowed somewhat and interest rates have risen, putting further pressure on credit quality. Another factor in weaker consumer credit quality may be the rise in total debt as a percentage of disposable income. Obviously, people with higher ratios are less likely to withstand economic setbacks. The overall rise in debt can be traced to the 1970s, when the baby boom generation first began to establish households and thus more inclined to consume and increase debt levels in the process. In this regard, it should be noted that as baby boomers draw closer to their retirement years, the ratio of debt to disposable income may decrease as saving for the golden years becomes a predominant objective. Finally, we are seeing an increasing use of bankruptcy by middle-income consumers who have overextended themselves. This development may reflect a secular change in borrowers' attitudes toward debt and bankruptcy. Although there clearly has been some deterioration in consumer lending, we do not at this time believe that it poses a material risk to the national banking system. There are several factors working together to mitigate the credit risk posed by commercial banks' shift into consumer lending. Those factors include, one, historically low loss rates on residential real estate loans. Second, the relatively small average loan size for credit card loans. 3, the relatively wide margin obtained on credit card loans. 4, the diverse base of borrowers, both geographically and demographically in this area. And finally, an active secondary market for many types of consumer loans. Moreover, in the past several months, we've seen some tightening of loan underwriting standards by many national banks. Notwithstanding these facts, as bank supervisors, we must be cautious on safety and soundness issues. When we see credit quality slippage, we must ensure that banks have sound risk management systems in place and that banks are managing risks appropriately. Accordingly, in 1994, after our examiners began to see early signs of potential consumer credit problems on the horizon, the OCC took several steps to help us learn more about developments in consumer credit lending and enable banks to manage risk and operate their businesses profitably. At that time, in response to the rapid growth in bank credit card operations, the OCC formed a working group to take an in-depth look at the credit card industry and its evolution. During the second half of 1994, OCC examiners reviewed credit card operations at the 15 largest national bank credit card issuers. As a result of this effort, we call our credit card horizontal review, we identified several areas where operations could improve. We shared this information with the industry, and throughout 1995, our examiners worked with banks that exhibited shortcomings to ensure that changes were made to improve their operations. We also presented the results of our review to the other bank regulatory agencies and to the Federal Financial Institutions Examination Council. Further, findings from this analysis have been incorporated into our examiner training, and we factored this new information into our credit card examination procedures. We have been field testing these changes in recent months, and modifications to the Comptroller's Handbook are in the final stages of review. We expect new credit card guidance to be issued by the end of September. We also plan to release new handbook sections on installment lending, residential and home equity lending, and merchant processing. We also formed the National Credit Committee in 1995 to look at potential erosion of underwriting standards generally. This group, comprised of some of the most senior and experienced OCC credit analysts, helps us identify and respond to changes in credit risk that could affect the safety and soundness of the national banking system. Our National Credit Committee recently concluded its second survey, which looked at retail credit underwriting standards at the largest nationally chartered banks between May 1995 and May 1996. Our survey results showed a bias toward tightening underwriting standards as compared with the previous year's survey. The results are just in, and I can assure you that as we analyze them further, we will factor their findings into our supervision. In addition, our economists have conducted stress tests of bank consumer loan portfolios to determine how macroeconomic changes might affect the performance of these portfolios and banks generally. We intend to continue this modeling effort to ensure that credit conditions remain manageable and that there are no systemic problems on the horizon that require additional supervisory action. Finally, I want to mention that we have recently created a new position of Deputy Comptroller for Risk Evaluation. Scott Calhoun, one of our most seasoned examiners, holds this position, and he will be responsible for coordinating our efforts to identify risk, analyze trends affecting risks in the national banking system, and develop appropriate policy in particular risk areas, including at this time consumer lending. In closing, let me again stress that current levels of consumer credit do not pose material problems for the national banking system. However, we remain concerned about trends in credit quality, particularly given the rise in consumer debt and bankruptcies, and we will continue to be vigilant and proactive to make this area a priority for analysis, training, and constant reevaluation of our examination procedures. Thank you very much.
Thank you. We've been joined by Senator Fairclough. Any opening statement you might have?
Thank you, Mr. Chairman. And I want to thank you for calling the hearing. I think it's a very important issue, and it's one that I have had some apprehension and concerns about. Consumer credit card debt, as we've heard, is growing rapidly. In 1992, consumer debt was $800 billion. Now it's over $1.1 trillion. And it's been going up steadily every year, and now consumes more of people's earnings than ever. Default on credit cards at a 15-year high. Mr. Chairman, what concerns me are not the details that Ms. Yellen, Ms. Heflin, and Mr. Ludwig has given us, but they are mentioning the cautions they're doing, and Mr. Ludwig is to the banking cautions to slow it down, and that's good, and as it should be. But the problem lies with the federal government. How can you teach frugality to the citizens? How can you ask the people of the country to conserve, to use their assets well, to not go in debt, when we set a pattern and have set for 40 years of unlimited spending and unlimited debt? We borrow $160 million every day now. We are something out in the area of $900 million every working day to pay the interest on the debt, somewhere in that area. And supposedly we hear that every tax return, every taxpayer, about $800 and some odd dollars of that tax return goes to pay interest on the debt, the federal debt. So how can you encourage economy and, as again, frugality and conservatism in the American people when the government sets such an example? One of the oldest racetrack rules used to be, with horses, that if the mare trots and the stallion trots, how do you expect the colt to pace? And that's simply what we're looking at. We go right on spending here, and if you even mention cutting a program, you are more likely going to be identified as a Neanderthal man. By 2002, our national debt's going to be $6 trillion. And we have absolutely no plan to pay it off. I haven't heard anybody even mention a thought about paying anything. We talk about cutting the deficit, and we have done some, and that's good. But we talk about cutting the deficit. But the average person doesn't realize that just means we're going in bankruptcy a little slower, because each day our interest and our debt is rolling, and we aren't doing anything about it. I think it's up to the federal government to lead by example, to cut federal spending, to really balance the budget, and come forth with a plan to pay off the debt, rather than going on and on as we have, and we clearly have, encouraged the American people to follow behind us. I realize that my thinking is not very modern, Mr. Chairman, but I would tell a story that happened to me when I was about 20 years old, or maybe younger. My mother was a very shrewd businesswoman, and my father was very ill, and I wanted to buy a lot of equipment, bulldozers and very expensive equipment, and I went to her of course the bank wasn't about to lend me the money unless she would sign the note. That was back when banks were very realistic about collecting the principal. And went on to the house for 2 or 3 days, and she wouldn't sign the note, but she didn't say absolutely she wouldn't sign it. She just said very little in a very quiet Scottish way. And one day I came into lunch, and she had the debt and the debt service written on a handkerchief, and what I had given her is a supposedly crude pro forma as to what I expected to make in my income and from these bulldozers. And it was written on a handkerchief, and she says, "Is this the figures?" And I said, "Yes, it is. The debt service, what it's going to be, and the income." And she handed it to me, and she says, "Go and wash it." And when I stuck it under the water, I saw what she had done. She had written the debt in indelible ink and the income in fruit juice. And she said, "Your income can go in a flash, but your debt will be with you till you pay it plus interest." And too many people in this government have never faced the fact that the debt is going to be with us till we pay it plus interest.
Did you get the loan?
Another story. Another story.
I'm not going to tell you what really happened. She gave me the money. Mr. Chairman, thank you.
Governor Yellen, I have several questions. I will try to stay within my time because we've got other senators here. You cited the high incidence of borrowers with substantial credit card debt declaring bankruptcy without any previous record of missed or delinquent payments. Why are bank controls and monitoring procedures unable to detect this?
I think, Senator Shelby, that banks' procedures, they're relying increasingly on credit scoring models in issuing credit cards, and I believe banks have found that those models are not very good at predicting bankruptcy. My understanding is that banks are working quite hard at this point to develop better methods to predict bankruptcy, but some of the techniques that they've used are not very good at forecasting
Chairman
bankruptcy.
do you want to comment on that?
I would say that it is true that about 50% of credit card losses are from personal bankruptcies, which is a very high number. There can be factors such as catastrophic problems, illness, automobile accidents where there's no insurance, and divorce, other personal problems which can cause catastrophic financial difficulty leading to personal bankruptcy without the normal in-between of being overdue on the debt. Those are very difficult to predict, even with improvements in models, but it is certainly true that these models have not been good at predicting the increasing levels of personal bankruptcies.
Mr. Ledby?
Well, I would add that we're actually seeing, I think, a secular change to some degree in bankruptcy patterns, which would not have been anticipated looking at historical data.
Does that concern you?
It certainly does. I think those secular changes probably relate to our attitudes towards debt and bankruptcy, which have changed in this country. I think that's why we see the banks didn't pick it up initially. It's being monitored closely by us and by the banks.
Okay. Mr. Ludwig, page 7 of your testimony states that the, quote, high returns associated with credit card loans have lured some bankers into the business without having adequate risk management systems and human capital in place. How widespread is this in the banking community?
Not very. As I indicated, the number of banks that are heavily committed in the credit card area is really relatively small, though the numbers are growing. New entrants into any innovative market, particularly a growing market, have to be watched pretty closely, and those are the...
you believe you have the tools at the Comptroller's office and you, Ms. Helfer, to monitor that? Because it is different, and it's different trends, is it not?
Yes, sir.
Yes, we do. We believe we can monitor it effectively.
Do you think these risks pose an undue threat to the institutions?
No, we are not.
Not at this time, anyway.
No, we certainly at this time are not seeing significant losses. In fact, we have seen an increase in some of the reserves, which suggests that right now we have the highest reserve coverage for potential losses that we've seen in quite a while. That's very much a positive. And as we've indicated, many of us, the institutions that engage significantly in credit card lending are institutions that have generally higher capital levels, and they have put in place fees and interest rates which more than offset the losses.
Okay. You agree with that, Governor?
Yes, I do. I think the credit card banks are unusually profitable and would agree that they understand they're bearing more risk in this area of lending, and it is nevertheless a very highly profitable activity.
You think they're probably understanding it a little more these days with such losses with some of them?
Absolutely. I think they're being quite responsive to the losses, which is a good sign.
As regulators, you're going to make sure they're responsive, aren't you?
Yes, we are.
Chairman Helfer, in your statement you said, and I'll quote, that sustained unfavorable interest rate movements could pose substantial risk for home mortgage lenders. Define substantial. What do you mean? And tell us if 100 basis points increase over a year would qualify as a sustained unfavorable interest.
No, I don't believe that would be a sustained problem, but you do have the kind of phenomenon that we certainly saw in the early 80s, that if we had a very significant increase in interest rates, and by that I think significantly over 100 basis points, you can see that there could be stress on the funding capabilities of banks given the outstanding interest rates on their assets.
Senator Bryan.
Thank you very much, Mr. Chairman. Mr. Ludwig, you made reference to a secondary market in credit card receivables. I must say that I've not previously been aware of that. Would you describe how widespread that is and what the implications are?
Well, it's very significant, Senator. There has been roughly a doubling to in the neighborhood of 67% of credit card assets are securitized. In particular, this is largely a non-recourse market to the original issuer, although there are issues with respect to reputation risk and others that make that situation more complex. It is both it's sort of a two-edged sword, like all these things often are. In one sense, it's a significant benefit from a safety and soundness perspective. It means that banks can lay off their risk to a broader market, and a market that in which there's a considerable amount of disclosure and a public evaluation of the credit card assets. At the same time, by a broader market and increased opportunity to lay off these credit card receivables while they are non-recourse. It also means that there is a tendency to want to support them, so it's a two-edged sword, but it is largely a positive development.
So, do you have any comment on the secondary market?
No, I agree with the analysis that it is largely a positive development, but it can, if there are significant problems ultimately in the portfolio that's securitized, put stress on the institution to support in times of problems. We are not in that situation now, but I think it's something that monitors, that merits close monitoring.
Is it the high risk of credit card debt that is the primary catalyst for this secondary market?
Actually, I would guess, and this is a guess, but that it is the predictable level of profits actually that come from the fact that the vast majority of all this credit card debt is in fact paid off and serviced. And that makes it, and in fact, if you consider that there are a large number of borrowers because they're spread across a large number of credit card holders, and you consider the extended loss experience that individual institutions have, they can come up with fairly accurate, but not perfectly accurate, loss predictions, which can be a sound basis because those are low relative to the income on the debt, which can be a sound basis for securitization and make them more attractive.
Governor Yellen, you have any comment?
Well, I would agree with the comments of my colleagues. I think that the new technologies that banks have developed and are using, particularly credit scoring, does, as Chairman Helfer just emphasized, enable them to predict quite well what the likely losses on pools of assets will be, and I think that that aids securitization. And I think securitization, by and large, is a healthy phenomenon. It's brought in new pools of money into this market in the same way that we saw with the mortgage market. It's enhanced lending outside of commercial banks.
Several members of this committee, including myself, had the misfortune of serving in this committee in the aftermath of the savings and loan disaster. And one of the things in retrospect that appears to be particularly self-evident is the fact that those losses tended to be concentrated regionally. If you take a couple of states, take those out of the equation, the circumstances would have been much less dire. With respect to the overall trend, and you've all indicated that you don't see a risk currently to the system, and that's good news, although we clearly want to monitor what's occurring, and you've all indicated to Chairman Shelby that you intend to do so. My question to you is with respect to any of these trends as we look at this credit card debt, how it grows, are there any indications, any kind of regional disparity there that suggests that a particular region of the country suggests that there is more of a problem than another region, or are these numbers sufficiently diverse that they reflect an overall trend as opposed to a particular region of the country? Chairman
let me just say two things that we found. Number one, the virtue of credit card debt is that there is an inherent diversification in the debt because it's spread across the country and across many borrowers in their relatively small numbers. We did find in analyzing the personal bankruptcy data a fairly odd trend, not one that I expected, which is that the largest number of personal bankruptcies are in the southeast and the west of the United States. Those are not explained, I might add, by unemployment rates in the individual states, which in the southeast have currently been relatively low. They tend to be explained by other factors. For example, states that don't require automobile insurance, where there's a significant loss, the individual, if he or she does not have automobile insurance, may declare personal bankruptcy. That's one example. But it does tend to be culturally related in some ways and not at all related to the economic numbers. That does suggest some other concentrations of problems in certain parts of the country. But I will say that not of the significant sort that you described during the S&L crisis, where 6 or 7 states explain, probably 85 to 90% of the losses during the crisis.
Thank you. I note my time is up, Mr. Chairman.
Senator Mack.
Thank you, Mr. Chairman. There's something that caught my attention in preparing for the hearing today, and that is, and I think it's reflected in one of the charts that you used a few minutes ago. And I understand from that chart and from what I had read that delinquency rates are about equal to what they were in the recession of 1980, about 15 years ago. I think was that the...
The delinquency rate in credit cards are just over 4%. They are not actually up to the 5.35 or so percent of 90 or 91. The 15-year high number you heard are the American Banker Association statistics, which they can certainly respond to, which relate to the number of accounts delinquent. That is at the highest level in 15 years. But in terms of total dollar numbers, we are not up.
Okay, but
we're about a 4-year high.
The number of accounts is at a 15-year high.
Yes. Delinquencies, yes.
I'm curious as to how you all... I'm curious as to what impact... Let me start over again. I mean, if you took this chart that you had, maybe I'll put it up there, the chart that shows the delinquencies and the bankruptcies.
Yeah. That's... Yeah. Okay.
Yeah. I wonder if we had superimposed over that kind of the periods of growth and recession, would we find something unusual going on? And again, I haven't looked at this, so I'm just making a guess at this point, that we are experiencing unusually high delinquency rates in a period of time, and we won't debate whether it's a strong economy or not, but you all referred to it as a strong economy. That we're experiencing unusually high delinquency rates for an economy that is not in recession. Let's put it that way. Is that a fair statement, or
well,
has anybody
sometimes
looked at that?
you certainly will see more extensions of credit, typically in expansionary periods, and that can have an impact ultimately on delinquencies.
Now, not the expansion.
I understand, but that can have an impact on delinquency. The more credit you're extending, you can have an increase in delinquencies. It can be because of a lessening of credit underwriting standards, and that's an issue we want to monitor.
Let me ask it a different way.
But personal bankruptcies, that is an unexpected number. We have not seen, this year the predictions are we'll exceed 1 million personal bankruptcies in an expansionary period. We have never seen 1 million personal bankruptcies in a single year before. And I think analysts are scrambling to try to understand that number, which is unexpected.
But at the same time, your chart shows that the delinquencies are also significantly increased during the last, what does that cover, about the last 6 quarters, last 5 quarters?
Yes.
Again, during an expansionary period. Yellen, do you want to...
I think if you were to look at the relationship between delinquencies and the economy, you would not see a close relationship between changes in delinquencies and changes in the economy. The timing of upturns in delinquencies is not closely related to recessions. What you often see is a large upturn in a recession in delinquency rates, followed by a decline, and then typically you will see a sustained upward trend prior to the next recession. This occurs for a number of reasons. In expansions, it's common to see rapid growth of consumer lending, and with seasoning, it takes a while before mistakes are recognized and loans tend to go bad, become delinquent, or have charge-offs. So my judgment on balance is that the cyclical relations we're seeing are to be expected and not unusual.
Let me just follow up, and then I'll let you hop in. A number of economists have predicted that after this second quarter, that we're going to see a slowdown in the economy in the third and fourth quarter. What do you think that will do to the delinquency rates and the bankruptcy rates that we see here?
I think we're likely to see a moderation in growth toward a sustainable pace in the second half of the year, but I think we will continue to see an economy that's operating at high levels of resource utilization, with unemployment rates staying in the neighborhood that they've been in for the last year and a half.
Which raises this question. If you were to take a look at unemployment rates and compare them to personal bankruptcy and delinquencies, is there a correlation there?
Well, I think probably in periods of recession you may see unusually high bankruptcy filings, but
I guess what I'm surprised about is to see the unemployment rate as low as it is, with the delinquency rates increasing and the bankruptcy filings increasing. I mean, there seems to be that there should be some connection with that.
Well, I think you do see a secular trend here, as the controller pointed out, that there is a long-term secular trend toward bankruptcy being used more commonly to deal with debt situations. I think there have been changes in the law that have made this a more palatable way of dealing with debt problems. It doesn't mean that previously households weren't dealing with debt problems. They may not have taken the form of bankruptcy. I think bankruptcy has become an increasingly attractive way of dealing with a debt situation from the household's perspective.
And let me just, I guess, ask the next question then. Do you believe that people are using bankruptcy more today because, again, some of the consequences for filing bankruptcy have disappeared?
I think the consequences are lower now than they used to be, and there have been legal changes that allow people to keep more assets in the event of bankruptcy that I think has enhanced its use as a way of dealing with a debt problem that perhaps has always existed, but now is being dealt with in this way.
Yeah. Ms. Helford, do you agree with that?
Yes, although I'll say that there haven't actually been significant changes in the bankruptcy code since the codification in 1978. So I'm not sure that the legal factors, I think that I certainly agree with Governor Yellen that there is seems to be more socially acceptable, to use the, if I can use that expression, to take personal bankruptcy, because we've actually seen an increase in individuals going from credit card debt that's being serviced or only a few days overdue or a few weeks overdue to personal bankruptcy. In other words, they don't go through the long delinquency periods that we saw in the past before they take personal bankruptcy. Now, that tends to be different on a state-by-state basis, but that's a very surprising trend.
Do you mind if
I think Mr. Ludwig had a comment.
Yeah, right.
No, I would share my colleagues' views. I'd emphasize the secular nature of this a little bit. That is, credit card debt is a little bit sui generis. It is an area of a considerable amount of innovation.
It's a little bit what?
Well, it's a little bit. The credit card debt is a little bit term. Sort of unique.
Tell them what you mean.
It's a little bit unto itself, unique. It's a peculiar specialty kind of lending that is innovating very rapidly, and it is not necessarily a proxy for other types of lending and lending patterns. So I think you have to view it a little bit as unique unto itself. And in respect to these bankruptcy patterns, I think that shows up, where long-term changes in consumer attitudes are very much reflected in these numbers, in addition to the cyclicality.
Mr. Chairman, if I could just pursue just again. I want to get a sense from you as well, Mr. Ludwig, as to attitude about bankruptcy.
I do think attitudes towards bankruptcy have changed. That's really part of my
point. I guess the question I was raising is it because of the perception now that there really is, I mean, that the price to be paid for filing bankruptcy is nowhere near what it was in the past? Now, when I say in the past, I can't tell you whether that was 10 years ago or 20 years ago, but I think we all recognize it that, 20 years or so ago, people just, I mean, to file bankruptcy, I mean, there was almost a sense that, it was the last thing that one could do, and that the character of the individual said, I just will not do it.
Yes, I think that is absolutely right. I think, look, in the 19th century, we put people in prison, debtor's prison, for debts. We've seen a historic...
I want to suggest it. I'm not saying that that's...
No, but we've seen you're not saying that. But we've seen a historic change, and that change seems to be continuing in terms of attitudes towards this.
Senator Mack doesn't go back that far.
No, Senator D'Amato.
Chairman, my nearsightedness necessitates my pulling this chart up, this little one, which is the one you see, talking about credit card loss rates and personal bankruptcy filings. I guess the personal bankruptcy filings are reflected by the red line. Is that correct? Yeah. And as I try to make sense of it, the thing that really concerns me, and I think it's more than just a social acceptability of being able to file today, and I think Senator Shelby makes a point that obviously there is not nearly the stigma and the long-lasting economic impact of filing bankruptcy. Can we all agree on that? That
yes.
Over the past, whether it's a decade or whatnot, there's been a period of time in which obviously attitudes have changed. Senator Locke Faircloth, there would be no way at any time or any place that he would ever consider that. That's been ingrained in his, and I didn't.
My Scottish mother.
By his Scottish mama, right. I won't tell you whether or not, the end of the story, whether or not his mother made the loan, but, but he did share that information with me, and I will threaten to reveal it at some point in time. But if you take a look at that chart, and I noticed that within take the first quarter of 1995, you begin to see this absolutely incredible increase. You see where it starts really moving up. In terms of the numbers, it is well below 200,000 quarterly, and now you've hit, and I'm particularly concerned with the fourth quarter of of 1995 and the first quarter of 1996, where you're just going up almost in a straight direction. During that period of a little more than a year, we've gone from about approximately 200,000 filings per quarter to 250,000. Now, I got to ask you something. Does that concern you? Is that something you're watching carefully to see if this is a trend that is more than just the availability of filing bankruptcies a lot easier and it not being nearly as onerous on individuals, et cetera? Because I think, I don't know if Senator Mack, because I was outside, was expressed this concern, but it's certainly, is that something that concerns you, Senator? In other words, is this the first indications of a severe deterioration in the business community, the small business man who's filing lots of these? Or are these filings coming in place just because it's John Q. Citizen who's run up a $10,000 credit card and finds an easy way to discharge that obligation? Is it a combination? What is it?
This measurement is personal bankruptcies, not business bankruptcies.
Personal.
So these are individual bankruptcies. It is certainly true that this will be the first time, if this trend continues with 250,000, as you point out, more than 250,000 in the first quarter, that we will have over 1 million personal bankruptcies in a single year. That is something that we have been analyzing every quarter at the FDIC. I'm sure you're aware that we put out our quarterly banking statistics, and we analyze them extensively. And this is one of the indicators we've been following quite closely for the last year.
Let me ask you last but not least, because we have a vote, but do you believe that most of this is attributed to the charges on the credit cards, or is it other factors as well?
Well, it's certainly other factors as well, although 50% of the losses on credit cards stem from personal bankruptcy, so there is a correlation there.
50% of the losses stem from, all right, they're discharging their obligations by filing personal bankruptcies. And the losses, I think, Ms. Helfer, in your testimony, you said it's up to 3.9% now? The bad debt that they're writing off?
Well, the credit card loss rate is, I think it's just over 2.5%, somewhere in there, if I remember the numbers correctly. But we are seeing a significant increase in the continuing loss rate. But remember, it's based on a relatively low level. Actually, the loss rate, as I recall, is over 4%. I misstated the number. It was the highest we've seen. It was in 1990, which was about 5.35%. So we're not at the peak, but we are seeing an increase, and that's the increase we're monitoring. Now, the anecdotal information and the more than anecdotal information that the comptroller reported in his survey of 83 large banks is that banks have started tightening their underwriting standards for credit cards. So we are seeing banks respond to these numbers, and you pointed that out in your opening statement. I think that's a very good result.
I have no further questions, and I want to commend Senator Shelby for focusing our attention, because it's an area that I think it's important that people understand, that the industries understand, that you are looking at, and to the extent that they are responding in a positive manner by being more selective and careful, keep ahead of that problem. We don't need the collapse to take place. I think that's important. And obviously, we're going to be looking very carefully at the filings. And if those personal bankruptcy filings continue, I'm going to be I think we're all going to be very, very much concerned. At this
Chairman, I'm sure these regulators are going to be concerned too, aren't they, if this trend continues?
Yeah, absolutely.
Well, I want to thank the panel and certainly thank my chairman. Senator Fairclough.
Thank you, Mr. Chairman. And I won't prolong the proceedings here, but I just had one or two thoughts. As Chairman Helfer said, they're tightening the constraints or restrictions on. They're not just floating them out to everybody, but are they still floating them out to far too many? I don't know how many go, but I throw away a stack of solicitations for credit card every week. When I got home, they just we say that these people are, you got 3% or something, and the bankruptcies come out of these. But are we dealing with a very gossamer thin, what downturn in the economy would it take to catapult that very thin line that are paying? How many of these people are substantial, have assets, and could carry a downturn in the economy? As we saw, it was mentioned earlier, in the savings and loan, as long as everything was love and bloom, we didn't have many. But these people are dealing in a very gossamer thin line between bankruptcy and getting that payment in 10 days late. What downturn in the economy would it take to catapult that into a disaster?
Well, it's certainly true that a downturn in the economy will have an impact on loss rates.
How much?
I can't tell you the precise number. Perhaps the economist on the panel can.
Well, I would agree that if there were, we don't anticipate it, but if there were a serious downturn in the economy.
One question. How many downturns have we really ever anticipated in the history of the country?
Very few. And certainly it's something that we have to be concerned about and to think about, and we do worry a good bit about low-risk events, a downturn sufficient to create serious credit problems and increase in bankruptcy for the household sector, I think is a very unlikely event, but we can't rule out the possibility that some shock would occur that could cause that to occur.
Another question, and this is in no way a partisan or have anything to do with the current administration or previous ones, but it's because it's gone over a series of administrations and political parties. And we're talking about this social acceptability of bankruptcy. I saw in the paper somewhere that Mickey Rooney had just gone through his second one. But do we, is that precipitated by the trend of the federal government in the last 30 years to teach the individual that they have no responsibility, that whatever befalls you from birth to death, there's a government program to take care of it? That it's very acceptable not to have personal responsibility. You don't really have any. If something happens to you, it's somebody else's fault. And so consequently, what I'm asking, are the bankruptcy laws way too lenient? Have they run the, are they running the, I assume that if the banks had less bankruptcies, less losses, the interest would be less on those people who pay their cards. So have we weakened the bankruptcy laws on a federal level that it's just very acceptable to, you know, that's somewhat expected to weave in and out a few of those before you?
Well, Senator Faircloth, the data, if you look all the way over to the left side of that chart, you will see about 500,000 bankruptcy filings in early 1984. That's significantly lower, obviously, than the number we're talking about as prediction for this year. The last time there was a significant, actually the codification of the bankruptcy law came in 1978. There haven't been significant changes since then. So I think actually based on those statistics, it's difficult to say there's a direct correlation between changes in the law and the rising bankruptcy rates.
Well, we're going to have to vote, but I think, Madam Chairman, I think what you're missing, it took the public a while. See, they gained this information by osmosis. They didn't get it overnight. And they are all of a sudden discovering that this is a very acceptable, fine thing to do, to file for bankruptcy. You know, there isn't anything wrong with it. It's my neighbor did it. How many bankruptcies do you think we would have? How would you see that trend line go if we took the automobiles the next day if we evicted them from their house the next day or within a reasonable length of time, and if we made the bankruptcy courts move rapidly to seize the assets, you can go in bankruptcy today and drive the automobile you have till you wear it out, and then dump it back on the dealer or the credit. We have made it, you can file bankruptcy and not change your lifestyle unless you had a really extravagant one.
Well, I certainly don't want to be in the position of claiming to be a bankruptcy expert. I will say that it is certainly true that the bankruptcy laws permit individuals to retain sufficient assets to carry on a business, and those may include, if they need to have an automobile to carry on their livelihood, that they can retain it. I think that's really... Yeah.
I've got to go vote. Have you ever heard of them taking an automobile in a bankruptcy proceeding short of at least 18 months to 2 years?
I don't have those statistics, but I think it is certainly true they can often hold on to the cars.
We've got a vote pending. I've got several questions I want to send you for the record, all three, but I want to ask all of you a yes and no question. I know these. Could the stringent enforcement of CRA be contributing to the lower quality of consumer credit? Governor? You want me to ask it again? Could the stringent enforcement of the Community Reinvestment Act be contributing to the lower quality of consumer credit?
I don't think that's a significant factor.
Okay.
I don't either.
Gene? Okay. I have a number of questions, as I said, for the record. We appreciate you coming. We've got a couple of votes, and we'll let you go. You've got other things to do. I hope you're going to regulate the bankers well, but not too much, you know. Thank you a lot. And we've got another panel, and as soon as we get off the floor, we'll come right back. Thank you.
Thank you, Mr.
Committee
Chair.
will be in recess.
Housing programs, the new article.
Thank you.
Subcommittee will come to order. I apologize for the vote to all of you. We had two back-to-back votes. Our second panel is Mr. James Chesson, Chief Economist, American Bankers Association. Mr. Edward Bancoli, Senior Banking Analyst, Moody's Investor Service, and I know it's Dr. Donald Radachek, Director of Economic Forecasting Center, Georgia State University. Doctor, we all read about you and we watch what you say and what you do. Dr. Radachek, you want to proceed? Your opening remarks, your written remarks, if any, will be made part of the record in its entirety, and you may comment and say anything you please.
Thank you very much.
We welcome that.
If I look tired, it's because last evening I was watching the women gymnasts.
In Atlanta.
Which was a very, very valuable ticket.
It is.
Anyway, thank you for...
And they did quite well, didn't they?
I thought it was a very courageous performance.
You go ahead, Doctor.
Thank you for allowing me the opportunity to discuss the growing concerns about consumer debt and rising bankruptcies in this country and their implications for economic conditions and burdens faced by financial institutions. I see fewer concerns than many about the growth of consumer debt as a percentage of personal income, at least into 1997. The growth of balances from cards that provide some benefit to those charging, such as support for a school or charity, what's normally called affinity cards, or the opportunity to earn free airline tickets, as well as the growing use of charge cards for grocery and gasoline purchases, accounts for much of the surge in revolving credit. Also, while household debt has been growing by 7.1% and consumer installment debt by 13.5%, household assets have been expanding by 15% in the past year. Therefore, household net worth has actually increased by nearly 20%. On average, the household sector actually has more capacity to take on debt than a year ago. However, the growth in debt has created additional financial stress to the 60% of households that do not hold substantial financial assets. In the past year, credit has become more available to these households through loosened credit conditions, leading to increased purchases for non-durables and services. Because of strong gains in their investment portfolios, along with favorable interest rate spreads, financial institutions appear to have aggressively sought consumer loans. We have heard today that they are reversing that position. As a consequence, the quality of the consumer portfolio has deteriorated, leading to much of the growth in past due accounts and contributing to the bankruptcy problem. In general, the added risks in the consumer portfolio have been profitable to banks. However, reduced gains in the investment portfolio may lead to some tightening of credit conditions. Initially, this will lead to more signs of consumer stress, causing cyclically high gains in past due accounts and another 10% growth in bankruptcies to more than 1.2 million in 1997. I should preface here that I am not using the conservative forecast that the first quarter will be repeated throughout the year, but trying to make a judgment of where the trends are going. And we're going to have more than 1.1 million bankruptcies this year. And we expect to have more than 1.2 million in 97. While bank earnings could fall in 1997 because of these pressures, earnings will be adding to capital. Thus, stress upon financial institutions and their depositors should be minor. I believe the stigma of bankruptcy is falling as more filings occur. Indeed, the current codes unduly encourage risk-taking in real estate holdings. In addition, ownership transfers to relatives have allowed filers to maintain living standards even as creditors experience reduced recovery from accounts under stress. In my comments, I suggest remedies for these problems. I believe concerns about rising debt ratios and signs of growing financial stress by a segment of the household sector are justified. However, household net worth has been growing rapidly, which probably means consumer spending, while slowing from above-trend rates of growth in the first half of this year, will remain healthy. Also, financial institutions may not profit as much from their consumer accounts next year as they have so far this year, but they have sufficient capital to weather deterioration in the performance of their consumer loans. Again, thank you for providing me the opportunity to share my views.
Thank you. Mr. Bancoli, your written remarks will be made part of the record. In its entirety, if you'll just comment, say what you please.
Okay. Good morning, Mr. Chairman. I thank you for inviting me to speak on this very timely topic. My name is Edward Bancoli. I am a Vice President in the Asset-Backed Finance Group.
Would you pull the mic up closer to you?
Sure.
Thank you.
Is this better? Okay. I am a Vice President in the Asset-Backed Finance Group within Moody's Investor Service. In my group, my colleagues and I assign ratings to securities that are backed by pools of assets, which are mainly consumer loans. And the bulk of these loans are credit card loans. In 1996, about $125 billion of these types of securities is expected to be issued and rated. Nearly one half, or $60 billion of that, will be backed by credit card loans. In assigning the ratings, we look into the methods of account origination and the process by which the accounts are serviced. These factors enable us to gauge how the loans are likely to perform in the future. Even after ratings are assigned to the securities, and mainly for the benefit of investors in these securities, we monitor the pool performance in these credit card loans. As part of that process, I publish what we call the credit card credit indexes. And the indexes include the delinquency rate, loss rate, portfolio yield, and repayment rate in credit card loans. The average quality of the American consumer is weakening. That is evident in all of the factors we have heard about. In the second quarter of this year, the loss rate in credit card loans is expected to average 5.5%. That is about a third higher than last year. This trend is all the more worrisome because the economy is still relatively healthy. What is driving this deterioration? The answer is that banks and other lenders have placed cards in the hands of a segment of consumers with weaker ability to meet their growing obligations. As a result, average credit quality has declined. Both banks and other lenders have been driven by competitive pressure to tap into a weak segment of consumer base. The market dynamics for credit card lending have changed significantly in the last 3 years, partly because of the profit potential, which has also attracted non-traditional lenders, and also because of the secondary market for credit card loans called securitization. Securitization has increased the flow of credit card loans, especially to the marginal consumer segment. That is seen in the rising loss rates. That is also seen in the originations in 1994 and 1995, which are mostly targeted to average credit profile borrowers. In light of these developments, the outlook for average consumer credit quality is one of continued but slower deterioration through 1996 and into 1997 if the economy remains stable. The loss rate will vary from lender to lender depending on the degree of risk exposure. But for banks, weakening consumer credit quality is not expected to have a debilitating impact for several reasons. One is that, as we have heard, credit card loans actually represent just about 5% of total bank assets. And about 2/3 of the credit card loans outstanding are actually held or owned by people with average to above average income. And the current write-off rate is still below the peak we saw as a result of the last downturn. Also, within these balances are something called convenience use balances, which are simply because of the increased acceptance of credit cards as a means of payment. As a result of these factors, the outlook for banks remains stable to improving. That is because many of the current problems have already been anticipated and are reflected in the current assessment of bank credit performance. Banks, as we have heard, have also begun to take steps to shore up portfolio quality by pulling back on marketing and tightening underwriting standards for marginal quality borrowers. Non-traditional banks that concentrate in credit card lending could experience higher credit pressures and possibly slower profit growth. A mitigating factor, however, is that non-traditional banks have the technology, the management, and information to monitor their customers and to take steps quickly to stem adverse trends.
Mr. Chesson, your written statement will be made part of the record in its entirety.
Thank you, Mr. Chairman. I'd be remiss, Mr. Chairman, if I didn't mention at the outset that we certainly agree with Chairman D'Amato's comments about the need for regulatory reform, and want to say to you that the ABA strongly supports your personal efforts to have meaningful regulatory reform enacted this Congress. Today, I think these are very important hearings, Mr. Chairman. The banking industry holds 45% of consumer credit, so the level of consumer debt and consumer credit delinquencies are topics of considerable importance to bankers. Recent stories about rising delinquencies have raised concerns that consumers may have taken on more debt that they can handle and may mean serious trouble for banks and the economy. I believe that the increase in consumer delinquencies does raise a yellow flag, indicating that borrowers should think carefully about taking on more debt and lenders should exercise prudence in extending new credit. But I firmly believe that it does not spell disaster for the economy, consumers, or the banking industry. Mr. Chairman, I'd like to make 3 points this morning. First, consumer credit has grown rapidly over the past 3 years due to a strong economy, the growing acceptance of credit cards as a means of payment, and a very, very healthy banking industry. Second, the ratio of consumer debt to income has risen over the past 4 years, and some individuals are now finding it difficult to continue to meet their obligations, and that is troubling. And third, rising consumer delinquencies are a concern for lenders, but do not pose a serious threat to their financial condition. Let me briefly touch on each of these 3 points. There are many reasons why consumer installment credit has been expanding at an annual rate of almost 12% since 1992. First is the impressive performance of the economy. Greater consumer confidence, rising incomes, and increased wealth from investments have led to more consumer spending and increased use of consumer credit. As consumers feel more confident that the economy will remain strong, they believe they will have the capacity to meet higher debt obligations. Second, consumer debt is also rising because the number of places where consumers can use credit cards is rising. Today, you can pay for anything from your grocery bill to your doctor bill with a credit card. Moreover, incentives such as frequent flyer mileage and credit for gasoline have encouraged consumers to substitute credit cards for cash and checks. Third, consumer debt has expanded because banks are very healthy and can meet the growing consumer demands for credit. Industry earnings are strong, problem loans are at record lows, and capital and reserves are at record highs. The growth of consumer debt has outstripped the growth of disposable income and pushed consumer debt burdens to historically high levels. The rising consumer delinquencies are the best evidence that some consumers are reaching the limits of their debt. This raises concerns that consumer spending will be less robust, and I think is one of the reasons why economists are forecasting a slowdown toward the end of this year and into '97. But what do the consumer delinquencies mean for banking? Clearly, rising consumer delinquencies should be closely monitored, but there is no reason for alarm. Banks are already becoming more cautious and have already taken steps to reduce their exposure. In fact, the banking industry today holds a lower volume of consumer loans, including credit cards, than they did at the start of this year. They have already responded to the rising delinquencies. Moreover, the potential losses are not great enough to create substantial problems for the banking industry. First, the exposure per individual customer is very small. Second, banks' loan portfolios are well diversified. And third, the industry has record levels of capital and reserves, enable it to easily handle even the highest plausible levels of consumer losses. I think it's instructive, Mr. Chairman, to note that the banking industry, if it wrote off every dollar of every non-performing loan, both business and consumer loans, every dollar of those loans, there would still be $22 billion in reserves left over, and that doesn't include the $350 billion in capital that the industry now has. We have tremendous amounts of capital and reserves. Given the strong financial condition of the banking industry, consumer delinquencies pose no serious threat. Finally, Mr. Chairman, the banking industry is involved in consumer educational efforts designed to help consumers use wisely. I brought some brochures here to demonstrate that are both in English and Spanish, such as how to choose, use, and not abuse your credit card, managing credit card debt, holiday debt tips for coping. We're very active at the American Bankers Association in producing these kinds of things for our bankers to use, because no one is served when consumers take on too much credit and can't meet those obligations, and we try very hard to meet those needs. We're also very active as local partners in community and consumer credit counseling services. Banks have a vested interest in helping their consumers use credit responsibly, because no one benefits when loans go bad. While the media is focused on rising levels of delinquencies, we should remember that the vast majority of individuals are meeting their obligations. In fact, if 3% of individuals are delinquent, it means that 97% are not delinquent, and we need to keep that in mind. Prudent lending in the face of rising delinquencies is appropriate, and I have to say that we need to be sure that the regulators do not overreact and slam the brakes on consumer lending. To do so would certainly have a negative impact on the growth of local economies, and I think we all remember too strongly what happened in the early 1990s when the regulators overreacted and created the credit crunch that we saw in the early years. I would hope that this would not happen to consumer lending, because I think it would be devastating and we would not have credit in the hands of consumers that deserve it. Thank you, Mr. Chairman. I appreciate the opportunity to present these views.
Thank you. Dr. Radicek, how concerned are you about the rising number of bankruptcies in the country, personal bankruptcies?
Well, I'm concerned about the bankruptcies. As you've heard today, 50% of all of all the installment debt write-offs are because of personal bankruptcies. And as these bankruptcies grow, and clearly they're growing at double-digit rates,
that's alarming in itself, isn't it?
Yeah, it absolutely is. And you would expect that the write-offs will go along with it. Indeed, I think perhaps you heard a little bit less alarm than is justified for the bankruptcy changes. I think the economy is reasonably okay, but there is a problem in the bankruptcy area.
Do you believe that the lax bankruptcy laws have contributed to this? Or is it an attitude of people?
Well,
or a combination?
As mentioned, the bankruptcy codes, I believe, came into force, the current ones, in 1979. There have been some adjustments, but not major changes. Since that period of time, those bankruptcy laws were designed to be compassionate and allow people to get back on their feet in a period of time where bankruptcy was viewed as a last resort. It is becoming clear that for many people, bankruptcy, first of all, is a primary way of escaping debt. Secondly, I do believe that there is some real estate risk-taking being done. People buying more house than they need for a home.
Can afford.
Well, in a hope that the house will appreciate, and if it doesn't, they go bankrupt. And they are protected in holding their house position because of the current laws. That's why I do recommend that if we review the bankruptcy laws, and I think we ought to, given this new social feeling about bankruptcy, that we ought to be more stringent in what is allowable as an asset that can be kept to get people back on their feet.
What would your advice, if any, to be to the regulators? You heard them testify this morning. Were you here earlier when...
Oh, yes.
Okay. They say they believe that they've got things under control. You know, I'd rather be ahead of the curve than behind it, and I know the regulators had. What would your advice be to them?
Well, I think
watch it?
Well, I think the regulators have to watch because, as you also heard this morning, they indicated that they're seeing an increase in the number of bankruptcies for accounts that are only a few days or weeks past due. And those are the accounts that are hard to predict. And so as a result, there is a problem. It looks like it is a growing problem, although I will have to agree with the Bankers Association at this time that the banks have ample capital to handle any foreseeable problem.
Mr. Bancoli, what would your advice be as a rater of debt in America with the reputation that your firm has, Moody's? What would be your advice to the regulators that testified earlier?
I think that would be consistent with what we heard earlier. One is simply to understand the degree of exposure that each bank is undertaking. One type of analysis that we have found very useful, and we encourage other people looking at the same problem to look into, is the performance of each segment of loans originated in each period, and then try to see if there's been a shift in underwriting, because these things don't tend to show up until 18 to 24 to 36 months later. By then, it's too late once you've already booked the loans. So the advice to regulators would be to try to understand the dynamics of underwriting and solicitation strategies for each bank.
What's your experience been, Dr. Radicek, as an economist, in a downturn? If we're having these bankruptcies now while we so-called are having an expanded, heated economy, what would a tremendous downturn signal?
Well, actually,
based on past history,
the business cycle indicates that your peak problems with, well, not with delinquencies and bankruptcies, but your peak problems with debt ratios actually precedes an economic downturn.
Okay.
That either the credit...
It's an indicator of what's to come?
That's right. Either the credit providers recognize that a problem is brewing and they cut back, or some households find that they better pull back before they get into too much trouble. But you do find that the credit ratio is a slightly leading indicator of economic conditions. But of course, we never know that that has peaked until it truly has peaked. Okay. The bankruptcies rise significantly in the first year of an economic downturn. Generally at 1.5 to 2 times the degree to which they were rising prior to the downturn.
So if that were true, assuming it is a true economic maxim, then if we're in a downturn, you could look for a lot more bankruptcies than you have today, could you?
Oh, I think the bankruptcy problem is a serious problem. And while it was mentioned that the cyclicality of it may have diminished, and that could be true, it's we could very well see a significant, at least for the first 12 months of an economic downturn, a significant, and I'm talking large double-digit increases in bankruptcies.
Okay. Dr. Radachek, in your testimony, you say that the record debt ratios may not be a problem as a rule because the average household has witnessed an increase in value of its total financial assets. Then you say that averages are misleading, but that even lower income individuals are possibly okay because they're still being extended credit. The regulators suggested some banks are starting to tighten their credit standards. Is this occurring sooner than you expected? And if so, what does this say about the urgency of the problem?
Well, I think what's happening is the banks are starting to become restrained at an appropriate time. Maybe they've already booked a few too many problem loans. We do know in the surveys of the credit scoring, I'm not a great lover of credit scoring, but it is one measure.
Is this the model you're talking about?
That's right. And that credit scoring number has come down dramatically in the past 2 years as lending institutions have become aggressive about seeking consumer loans.
In other words, the credit has become lax, has it not? More
That's
lax.
correct. Now, the latest survey does show some improvement in the new loans being written, that they are more stringent in those new loans, and that's what we're hearing. But, of course, those other loans are sitting on the books, and they will age, and they have a higher probability of being problem loans.
If they know they've got probably problems there, problems coming up, they better have the capital to take care of it, haven't they?
Well, they do have the capital.
That's good.
I think that's the one issue that we all agree on.
Okay. Doctor, you also stated that 90% of equity value is held by 20% of the households in your testimony, and that 40% of all households hold substantial assets. Does that mean that a majority of consumers don't have equity in financial markets?
Yeah, a majority of consumers, while they do have a position in the equity markets, they don't know it. It's in their life insurance reserves and their pension programs, which really is not going to influence their behavior. So when you
they don't really have access to that, do they?
No, not really.
Not disposable income? Or?
No, absolutely. So there's 60% of the households that truly do not have a significant fallback on assets.
Is the credit spree peaking now, or can credit remain a driving force in this expansion, which I understand is about 63 months old?
Oh, I think there is signs that credit activity is slowing. Revolving credit's still quite strong, but personal credit is the last 2 months has actually declined.
Mr. Bancoli, have credit card issuers marketed cards and increased volume at the expense of proper underwriting standards?
Mr. Chairman,
you want me to ask that again?
I understand.
Oh, you understand.
What we try to do is simply estimate how a pool of loans will behave over time. How risky the underwriting process is, it would be unique to each bank. What we try to do is estimate, once you've originated the loans, how will the pool of loans behave over time. But whether or not it's prudent for a bank to...
Is that based on what you would deem the quality of these loans?
Yes, what we call vintage analysis.
Sure. Okay. Currently, credit card loan losses are almost as high as they were in the 1991 recession. Can those losses go much higher this cycle?
Chances are they will.
They will. Doctor, you agree with that?
Oh, yeah. Well, you have a higher debt position.
Sure.
I would expect you to have somewhat higher problems.
Mr. Chesson, you agree with that?
I think we're going to see delinquencies continue to rise. One of the reasons we'll see delinquencies rise, though, is that banks are cutting back. So since you have a ratio of the number of loans delinquent to the total loans outstanding, you're going to see it rise just because of that mathematical relationship. Certainly there will be additional charge-offs that will follow, but I think the important point is that banks are well reserved in those cases. There's some that have added additional reserves, which I think is equivalent to taking an umbrella with you if you think it might rain. It may not rain.
That's better not having it, though, if it rains.
Absolutely. I think it's a prudent reaction to the rising delinquencies, and I think that's what banks have shown already.
I think that's what the regulators were pointing out today, and at least I read that. Mr. Chesson, you point out that current credit card delinquencies have reached a level that we've previously seen only in recessions, and that has to be a troubling sign. But why are we seeing it, and what does it mean to you?
Well, I think it is troubling because we're obviously not in a recession. I think there's a number of factors that have driven that case. I think the most obvious is that the consumer debt levels to income are now at very high levels, and I think it means that consumers have pushed the limits. I think it's instructive to notice the pattern, which was after the 1990 recession, consumers went on a debt-reducing diet. They really took efforts.
Paid it off, didn't they? Paid a lot of it down.
Yeah, they did. But unfortunately, they've added every single pound of that debt back, and I think that has to trouble us. And as Mr. Radicek mentioned earlier, that it typically is these very high debt levels that precedes the next economic slowdown. So I think consumers will restrict their spending and will add to the slowdown that everyone seems to expect.
I'll ask all of you, what will be the effect of banks cutting back on the pace, not altogether, but just the pace of consumer lending, looking at better quality, I guess you would call it credit standards? Will this send more people into bankruptcy and increase delinquencies, or how significant will this be for the economy? Just some cutback, some higher underwriting standards? Mr. Bancoli?
The effect would actually have, there will be two components to that answer. One is that in the short run, for the reasons we've outlined, i.e. the slower growth pace in credit card balances and the seasoning or the aging of the accounts previously booked, would actually cause the reported loss rates to be higher. But in the longer term, the tightened standards would actually help portfolio performance. But the effect on consumers is that cutting the access to credit flows would put a strain on a segment of consumers. One could argue that maybe this was a segment that possibly got credits because of looser standards to begin with. But overall, within the entire picture of consumer segment, it is not expected to cause any major asset quality problems.
Dr. Radicek, you're a noted economist. What's the economy? How long is this expansion going to go on? For the immediate future?
If I could know that precisely,
that, huh? We would be investing.
I'd be more than noted.
I know. No, you're noted.
This expansion actually has two pieces to it, which are very diverse. The one piece we're talking about today, which is the consumer sector, does appear to be starting to hit debt and credit constraints, and we would
consumer spending begin to wane a little.
We would expect to see the growth of consumer spending slow down significantly, probably in the next 6 to 12 months.
Okay.
That's the one factor that's occurring.
What's the second part?
The second part is that in 1994, a lot of corporations misread the degree of demand for especially the industrial materials. Prices had shot up very rapidly, and as a result, they had built up too much inventory. All during 1995, they've been liquidating that inventory, or at least slowing the growth of that inventory until the economy caught up with its need. And indeed, in the first quarter of 1996, they've actually liquidated some inventory. This puts them now in a position to increase industrial activity for the next half year or so.
That's in the manufacturing sector.
That's correct. So you have the consumer sector.
Is that durable goods mainly?
Excuse me?
Would that be durable goods?
No, it's both durables and non-durables.
Okay.
In fact, the largest liquidations in the last 3 months have been in the non-durables area.
What do you think interest rates are going to do? Go up? You know, look at the long bond, what it's done in the last, 6 months or less?
Well, the issue is which rate. We're now at a point that if the economy is growing above capability, to use the Chairman Greenspan's phraseology, that there is a potential for increased inflation. That potential will be recognized by bond investors, and they will push up long-term bond yields.
But there's some other factors out there, too, aren't there?
Oh, there certainly are other factors, one of which is the degree to which the bond investors believe that the federal government is reducing the government deficit. Earlier this year, they had stronger belief that the deficit was being aggressively attacked than they do at this time. And I think that's part of the reason why you've seen a full percentage point increase in long-term interest rates, but clearly also this concern that inflation may be spawned is causing rates. Now, I haven't answered your question. Your question is where are rates going to go? And we do have a forecast, and our forecast is the long bond is going to stay in the 6 3/4 to 7 1/4% range, probably for the next year. Short rates will go up. The Federal Reserve will find that their concerns will be sufficient for them to encourage higher targeted rates. And we, in fact, are assuming that there will be a half percentage point increase in short rates before the end of this year.
You see a lot of pressure on producer prices. I noticed the last report was not too bad.
And the next one, according to our surveys, won't be bad either. We're having some problems developing in the groceries, in the food area. And these are problems that don't look like they're going to be resolved quickly. So we are concerned. For instance, last year grocery prices were up 2.6%. Our current forecast for this year is a 4.2% increase and a 4% increase.
And what's that? What's doing that?
A lot of it is the bad performance of production, bad weather. Largely in the Midwest, and also the fact that we pulled down our inventories last year.
Okay. Mr. Banco, do you have any other comments?
No, Mr. Chairman.
Mr. Chasson?
No, Mr. Chairman, other than to assure you that the banking industry is well positioned for any consequence for rising delinquencies.
Okay. Well, I appreciate you coming here and waiting patiently while we go to vote. This will conclude our hearing. Thank you very much.
Thank you.
Everybody else voted. They're waiting on you.
Job is to be able to handle their debt. That's off the top of the head, so I don't know whether there really is data to support that. But this is not a strong economy. And for us to be willing to accept a position that 2.3% is strong growth and we ought to accept that is just fundamentally flawed. So with that opening remark, I will now yield back my time. Thank you, Mr. Chairman.
Chairman, I don't want to get into a debate with my friend, my colleague. I think the witnesses will offer a different perspective. I would simply say that Chairman Greenspan seems to be primarily concerned about the economy being too strong and reigniting inflation. So somewhere we ought to be able to have some kind of an agreement here that the economy is doing extremely well. In fact, I think growth projections are going to be this quarter something in the neighborhood of 4%. So we can discuss that with my friend and hear the witnesses. It'll hurt, I'm sure.
I don't know whether this will be the last word, but
probably not.
I think if you listen to Chairman Greenspan closely, what he is saying is that the economy is growing at its potential. To go beyond it is to risk inflation. The real issue is what is causing America's growth potential to be so low. Why is it 2.5% as opposed to 3.5% or above? That's the real issue. America's growth rate has declined because, frankly, of fiscal policy, not monetary policy. Fiscal policy that has layered on American business, American families, and the American worker higher levels of taxation, more Washington interference, and more regulation.
Senator D'Amato.
While I have my two distinguished members of this committee here, Senator Bryan and Senator Mack, both good friends, I would urge us to get together to get our deregulation bill on that floor. So please, both of you.
We agree.
All right?
Senator Bryan, I agree with that. We'll do our best to work at that.
And working together, Mr. Chairman, to make you pleased with our performance.
That would be, I mean, no, that would, I think that bill's a good, sound bill. I don't think there's any question on either side. There's some matters that we want to try to deal with, and I just would renew our request because, and I know that the chairman of this subcommittee, Senator Shelby, and let me commend you, and Senator Mack, have worked, and as have other members of the committee, to produce a bill that I think will help the economy, that will get rid of costly, unnecessary burdens that will actually free up tens and tens of millions of dollars that can be used as capital, expanded many times over.
I stated at the beginning of your comments that you would make a short statement. It was my intention to say I was going to make an even shorter one and not say anything, but I do have a prepared statement which I'd like to have included.
Be made part of the record in its entirety.
But I can't, and with all due respect to my dear friend from Nevada, I can't let some of the economic numbers that I heard. I really did not come here with the intention of getting engaged in some kind of economic debate. But the numbers that I see that reflect what's going on in the economy, if you take the last 4 quarters of GDP growth, if my memory holds right, it's about 1.7%. The last 4 reported quarters, 1.7%. Now, I know the President loves to talk about the strongest economy in 3 decades, but I mean, you know, that's a perception that I think that's going to be under attack during this between now and November. I mean, 1.7% GDP growth in the last 4 reported quarters. Now, there has been an increase in growth that was indicated in the first quarter. I think it was 2.8%, which was revised downward to 2.3% or 2.5%. I've forgotten which. It's expected high levels of growth in this next quarter that's going to be reported. But again, let's put this in context. In the 3 years that Clinton has been in office, the growth rate has been 2.3%, not 3.1%. This is the weakest economy, I would make the claim, the weakest economy in 3 decades, just the opposite. It's going to be an interesting debate that's going to take place between now and November. One of the other things that's going on is that people have analyzed that this gap, in essence, that's taken place. If we were to grow as we have in the previous 10 years to the Clinton administration, if we were to have grown at that same rate during these past 3 years, the typical American family would have had $260 more. And Mr. Chairman, I want you to hear this because it does relate to the ability of people to pay their debts. If the growth rate of the economy had been the same in these last 3 years as it was the 10 years preceding President Clinton, there would have been $260 more in monthly income for the typical family in America. So there is a real growth gap. And I believe that the Clinton economic policies have, in fact, are robbing America of its economic potential. And so, as I say, I really didn't come here with the intention of getting engaged in a debate about the state of the economy. Really was more interested in what was going to be said about the quality of assets of the banks in the country and credit cards in specific. But another point that comes to my mind as I was jotting these notes down again, there's a 17% increase in the number of individuals holding a second job in just the last 3 years. 17% increase. And for women, it's a 20% increase. So one could make the argument that people are in fact, taking second.
Little direct benefit from any gains therein. Secondly, one could argue those gains are only on paper and could be lost as quickly as they've been acquired. More importantly, much of this increase in household assets are locked up in pensions. That is, the gains cannot be made readily available to pay the mortgage or pay off credit cards. Bankruptcies and delinquencies have started to cut into financial institutions' profits. Friday, one company reported a 26% drop in credit services earnings, where provisions for loan losses has soared 89% in the second quarter. Unfortunately, it seems such losses are becoming a trend for the industry instead of the exception. Several financial newsletters are warning of the risk credit card portfolios that they impose on financial institutions. And one newsletter in particular has stated that credit cards are the #1 risk in banking today. In fact, now that the quality of credit card portfolios are deteriorating, some banks are trying to rid themselves of the problem by selling their credit card portfolios. The deterioration in credit quality is not, however, limited to credit cards. The Mortgage Bankers Association of America reported that the overall delinquency rate on mortgage loans, quote, has worsened over the past year, with the delinquency rate increasing 52 basis points from its level of a year ago and 56 basis points from its cyclical bottom reached in the third quarter of '94. The mortgage bankers go on to say that the seasoning of low down payment loans originated in '94 and early '95 and upward adjustments on many adjustable rate mortgages have contributed to the rise in the delinquency rate. The Mortgage Bankers Association of America was scheduled to testify here today but was unable to attend due to scheduling conflicts. But in short, delinquencies foreshadow losses. If consumers are already this far in debt and credit quality is already so low, what implications does this have for financial institutions if the economy slows or interest rates rise? What effect will a tightening by lending institutions have on consumer spending and the present state of the economy? To the extent banks find their loan portfolio overexposed, the greater the likelihood a downturn will cause unforeseen consequences. As one analyst put it, if consumer debt problems become serious, they won't be limited to the consumer. Virtually every business in the country will feel the impact. Senator Bryan?
Chairman, thank you very much, and let me preface my comments this morning by thank you for convening this important hearing. The subcommittee is holding this hearing against the backdrop of a strong economy. Economic growth has been robust. The private sector has been growing at a rate of 3.1% over the past 3.5 years. This growth has sparked the creation of more than 10 million new jobs and pushed the unemployment rate down to 5.3%.
A member of the Federal Reserve Board and the chairman of the Federal Deposit Insurance Corporation testified Wednesday. They talked about the effect of non-payment of credit card debt on personal and business finances. Republican Senator Richard Shelby chairs this 2-hour and 10-minute Senate Banking Subcommittee hearing.
Subcommittee will come to order. I will try to be brief on my opening statement. We appreciate all of you being here today. Credit delinquencies hit a 15-year high. Non-business bankruptcies projected to reach over 1 million this year, setting a second straight record. Credit quality of the average American credit card holder at a 6-year low. Net charge-offs for banks increased 58% in the first quarter. Default notices for mortgages jumped 38.3% in the first 4 months of this year. These are the headlines we keep seeing day after day in America. At the same time, we're being told that this is the best economy in a generation. Indeed, unemployment is at a 6-year low of 5.3%, and we're consistently receiving strong data on industrial production. However, despite the aggregate data, the benefits of this economic expansion do not seem to be getting through to the individual household. According to the Congressional Research Service, this expansion has witnessed the weakest growth of GDP when compared with 3 similar expansions. In addition, domestic sources of savings have been weak, and the investment spending has depended largely on foreign capital. The growth rate of productivity is the lowest compared to similar expansions, which might account for the weak growth in real family income. The growth in the labor force has been the lowest of the 4 expansions, which would help explain, I believe, the low level of unemployment. Last week, before the Banking Committee, Chairman Greenspan noted, and he said, voluntary job leaving to seek other employment appears to be quite subdued, despite evidence of a tight labor market. The point being that the workers are abnormally concerned with job security in this current economic environment. The reason I mention this morning is because some economists suggest the economy is doing very well and that consumers are simply using credit because they feel comfortable being leveraged in this economy because their net financial household wealth has increased thanks to the rise in the stock market. While that explanation seems plausible, I'm reluctant to buy it whole cloth. First, I'm not convinced that the majority of consumers using credit are doing so because of the rise in the Dow. A lot of consumers do not have equity in financial markets and therefore would reap that.
And for the first time in a long time, wage gains are outpacing inflation, which means that real wages are finally increasing. Given the strength of the overall economy, it is no surprise that the banking industry is decidedly healthy. Bank failures are down and bank profits are up. Faced with confident consumers, many banks have aggressively moved to expand their businesses, especially in the area of credit cards. And yet recent data indicates that there may be some cause for concern in the area of consumer debt. In recent months, banks have been reporting sharp increases in credit card losses and have been increasing their loan loss provisions to protect themselves from anticipated further losses. Over the last month, data has indicated that credit card delinquencies are at a 15-year high, and the percentage of people falling behind in their mortgage payments are at the highest level since 1992. To the extent that this data indicates a potential problem, the question arises is what causes these losses and what can it be attributed to? Credit card loans have become the fastest form of loan growth for banks in the past 2 years. Since 1994, 7,000 card issuers mailed more than 5 billion card solicitations to potential borrowers. This means that every person in America between the age of 18 and 64 received more than 32 card offers, and consumers are accepting these offers. Since 1992, outstanding credit card debt has increased by 47%. In fact, in 1995, there was $360 billion outstanding in credit card debt. Much of this growth is generated by banks tapping into new pools of potential borrowers. As markets for the most creditworthy borrowers become saturated with access to credit, only those markets with less creditworthy borrowers remain. And unfortunately, many of these borrowers in these markets are people who can ill afford to shoulder the high interest rates and high fees imposed as the cost of their loans. The fact that credit cards are being issued at a dizzying rate was recognized last week by Alan Greenspan, the chairman of the Federal Reserve Board. When asked at our last hearing, Mr. Chairman, by you, about the credit card delinquencies being at 15-year high, Mr. Greenspan said, and I quote, "We do recognize that the major cause of the rise is the extraordinary expansion that has occurred in recent years in the issuance of credit cards of all varying types," end of quote. Mr. Mr. Chairman, I look forward to today's witnesses for an elaboration of how banks are participating in what Chairman Greenspan has characterized as an extraordinary expansion of credit cards, whether banks are implementing changes in their credit card underwriting standards, and what the regulators are doing to monitor the increases in credit card debt from the perspective of both the banks and the consumers. And again, I thank you for convening this hearing and yield.
Senator Mack.
Thank you, Mr. Chairman. When I heard you